They told you trading is about charts, indicators, moving averages, candlestick patterns. They sold you the illusion that with the right system, the perfect setup, and just enough screen time, you could predict the market. But here's what they didn't tell you. The most successful trading firm on Wall Street, Susquehanna International Group, managing over $500 billion, doesn't let new hires trade until they master something very different. Not technical analysis, not price action, not even macroeconomics. Poker, yes, poker, and not as a casual game. It's a core part of their training, mandatory, non-negotiable. Because at SIG, trading is not about guessing the market. It's about understanding people. It's about mastering uncertainty. And above all, it's about learning to fold again and again and again until your ego gets quiet and your instincts get sharp. Because the best traders don't chase trades. They wait for the edge. The same way a pro poker player folds 80% of their hands, a world-class trader sits out until the market shows its cards. And when it does, they bet, not because they feel lucky, but because they know the odds. In this video, we're going inside SIG's poker-based philosophy to show you why the deadliest traders on Wall Street don't think like analysts. They think like card sharks. You'll discover the 10 principles that Jeff Yass, the poker-playing billionaire who built SIG from a dorm room, used to build assassins on the trading floor. If you've ever tilted after a red trade, if you've ever over-leveraged because you felt sure, if you've ever chased your losses, then this is the missing piece. Because once you start thinking like a poker player, the market starts to make sense. Welcome to the Poker Blueprint. And remember, this isn't just about trading smarter, it's about surviving long enough to win. Welcome to Trading Psychology Stick, where we decode the mental game behind profitable trading. Quick note, everything shared here is for educational purposes, not financial advice. Always do your own research and manage your risk responsibly. Chapter 1. The Folding Discipline. Why 80% of winning is waiting. You don't get to trade at SIG until you've folded 1,000 poker hands. At Susquehanna International Group, the 500B trading powerhouse, new hires don't start with charts, spreadsheets, or even lectures on financial markets. They start with a poker table. Why? Because trading at its core is a game of incomplete information. The faster you learn to manage uncertainty, ego, and risk, the faster you stop thinking like a gambler and start behaving like a professional. Poker is not just a metaphor, it is the training. Just like a pilot logs hours in a flight simulator, SIG traders log hours folding hands, sensing edge, reading risk, and learning when not to act. Just like a pilot logs hours in a flight simulator, SIG traders log hours folding hands, sensing edge, reading risk, and learning when not to act. Think of it this way. Poker is the dojo. Trading is the street fight. You don't survive the street if you skip the dojo. Think of it this way. Poker is the dojo. Trading is the street fight. You don't survive the street if you skip the dojo. You walk into your first week as a new SIG hire. You're expecting monitors, news feeds, maybe a Bloomberg terminal. You walk into your first week as a new SIG hire. You're expecting monitors, news feeds, maybe a Bloomberg terminal. Instead, you see poker chips. A SIG veteran hands you a stack and says, "Don't worry, you won't be playing much. You'll mostly be folding." A SIG veteran hands you a stack and says, "Don't worry, you won't be playing much. You'll mostly be folding." You sit, you fold again. Pocket nines, fold, suited connectors, fold. It feels wrong. Your instincts scream to play. You sit, you fold again. Pocket nines, fold, suited connectors, fold. It feels wrong. Your instincts scream to play. But here's the trick. They're not testing your poker skills. They're testing your discipline. They want to know, can you handle not acting? But here's the trick. They're not testing your poker skills. They're testing your discipline. They want to know, can you handle not acting? Can you sit with discomfort, with boredom, with temptation until the edge is clear? And when it is, can you strike without hesitation, but with perfect sizing? Can you sit with discomfort, with boredom, with temptation until the edge is clear? And when it is, can you strike without hesitation, but with perfect sizing? You're not being trained to chase. You're being trained to wait, to watch, to kill, not with aggression, but with clarity. You're not being trained to chase. You're being trained to wait, to watch, to kill, not with aggression, but with clarity. What most retail traders never learn is that the edge isn't in action. It's in selective action. The market seduces you into overtrading. The world rewards speed, hustle, more. What most retail traders never learn is that the edge isn't in action, it's in selective action. But SIG teaches the opposite. Win by doing nothing until doing something is inevitable. The market seduces you into overtrading. The world rewards speed, hustle, more. But SIG teaches the opposite. Win by doing nothing until doing something is inevitable. Here's the shocking statistic that changed how I see trading forever. Amateur poker players play 50 to 70% of their hands. Professionals, 15 to 25%. That's a 3x difference in selectivity. Now apply that to your trading. If you're taking more than 2 to 3 trades per day, you might be playing like an amateur. The market doesn't reward participation trophies. It rewards precision. In the WSJ roundtable, SIG traders talked about pot control, keeping the stakes small when clarity is low. They'd rather miss a win than chase a maybe. One trader put it bluntly, "If I re-raise and you have ace-queen and an ace hits, I'm cooked." So he folds, not out of fear, out of respect for variance. And in trading, that same logic saves lives. Think about this. Every trade you don't take is a trade you can't lose. Every setup you skip is capital preserved. Every urge you resist is discipline gained. The money you don't lose is money you've already made. But here's what's counterintuitive. Waiting isn't passive. It's the most aggressive stance you can take. Because when everyone else is bleeding from overtrading, you're sitting there with full capital, ready to strike when the real opportunity appears. Pros fold 80% of the time. Amateurs trade every setup. This isn't just a poker principle, it's a survival mechanism. Because patience isn't laziness, it's selectivity. It's the ability to stare at 19 bad hands and say no so you're ready for the one great one. It's what prevents tilt, burnout, overtrading, and system decay. And more importantly, it keeps your capital intact. Let me ask you something that might hurt. When was the last time you sat through an entire trading session without placing a single trade? If your answer is never, that might be exactly why you're struggling. Comment below with the longest you've ever waited for the perfect setup. I'm curious if anyone here has the discipline of a SIG trainee. And if you're thinking, but I'll miss opportunities, remember this. The opportunities you miss while being patient cost you nothing. The fake opportunities you chase cost you everything. Here's a story that still gives me chills. A trader at SIG once went 3 full weeks without placing a single trade. His colleagues thought he'd lost his nerve. Then, when his exact setup appeared, he sized up appropriately and made more in one trade than most made all month. The lesson? Patience compounds. Impatience bleeds. So, here's my challenge. Can you go 1 full week only trading your highest conviction setups? If you take the challenge, comment, patience mode, on below. But patience without purpose is just procrastination. You need to know exactly what you're waiting for. Which brings us to the most uncomfortable question in trading. Do you actually have an edge? Or are you just another player at the table waiting to be harvested? Chapter 2. Finding your edge. If you don't have one, you're the one being farmed. If you can't say where your edge is, you don't have one. You're someone else's edge. In both poker and trading, one brutal truth rules them all. Someone at the table has the edge. And if you can't see who it is, it's probably you. Most traders operate like casual poker players, betting blind, hoping the flop favors them, and calling that strategy. But SIG doesn't hope. They map the market like a battlefield. They know who they're exploiting, and more importantly, they know why they're allowed to win. Trading without a known edge is like stepping into a sniper duel without knowing where the bullets are coming from. A SIG exec once said, "Every strategy we deploy is built on someone doing something non-economic." That could mean a fund is forced to unwind, a retail trader is over-leveraged, a market maker is off balance. But the key is, there's always a reason. They don't just trade charts, they trade behavior. They exploit inefficiencies others can't even see. Like, when retail traders pile into low delta calls during a hype wave, SIG is already selling premium. They don't chase pumps, they anticipate crowd psychology. But looks bullish is not an edge, it's a feeling. And the market eats feelings for breakfast. Edge isn't something you hope for. It's something you can name, defend, quantify. At SAG, if a trader can't articulate where the alpha comes from, not just in theory, but in real-world mechanics, they don't get funded. No matter how confident, Because confidence isn't edge, clarity is, and if you're not clear, then you're the one being harvested. You're just another liquidity provider for the real sharks. Let me blow your mind with how specific real edge looks. Here's what SIG traders might say. We sell volatility when implied exceeds realized by 20% for more than 3 days in assets with over 1B daily volume. Specific, measurable, exploitable, not I trade breakouts. That's not edge, that's hope. Edge has numbers, edge has victims, edge has mechanics. If you can't identify all three, you're the edge. Can you answer this right now? Where does my edge come from? Not vague, not I'm good at entries, but specific. What behavior are you exploiting? Whose mistake are you monetizing? What inefficiency keeps reappearing? If you can't answer, then you're not playing the game. You're paying to play, and the market loves players like you. Time for a reality check that might sting. I want you to write down your trading edge in one sentence, not a paragraph, one sentence. If it takes you more than 30 seconds, you don't have one. Drop that sentence in the comments. Let's see who actually knows their edge versus who's been gambling with good intentions. This exercise alone might be worth more than any trading course you've taken. Here's the uncomfortable truth about edge. It's not permanent. Every winning strategy has a shelf life. Every trend ends. Every algo gets reverse engineered. The question isn't whether something works. It's how long before the market adapts and makes it stop working. That amazing arbitrage you found, give it 6 months. That perfect indicator combination, the algos are already learning it. Your edge isn't just competing against the market. It's competing against everyone who's watching you win. You know why most retail traders lose? It's not because they're wrong about direction. It's because they're trading against someone who knows exactly why they'll lose. Market makers know you'll chase. They know you'll panic. They know you'll revenge trade. They've built algorithms around your psychology. You're not trading charts. You're trading against predators who've studied your species for decades. But here's the good news. Once you identify real edge, once you know exactly what inefficiency you're exploiting, something magical happens. You stop seeing random price action. You start seeing patterns of behavior, patterns you can profit from, patterns that repeat because human nature doesn't change. The market might evolve, but fear and greed are eternal. Now that you understand edge, let me show you how the market lies to your face every single day. Because even with perfect edge, if you can't read when someone's bluffing, you'll still get destroyed. Chapter 3. Reading the Bluff. How to decode market psychology like a poker player. The market bluffs every day. Most traders fall for it. Bluffing isn't just a poker move. It's the core mechanic of crowd behavior. The market constantly sends signals that look strong but are weak. Looks bullish but are traps. Looks random but are psychological setups. And the traders who lose the most are those who react to price instead of reading intention. Bluffing is like a magician's misdirection. The hands move, the lights flash, but the real move is hidden behind what looks obvious. In the WSJ video, SIG traders talk about watching other players, not just their hands, but their reactions to the flop. One trader said, "I don't look at the cards, I look at you watching the cards." Why? Because humans leak information, even when they don't mean to. A twitch, a sigh, a glance. Markets leak the same way. A fake breakout to trigger stop orders. A sudden spike in low-volume altcoins. A massive green candle right before a dump. The goal isn't to beat the pattern. The goal is to beat the people behind the pattern. Imagine this. You see BTC breakout. Volume's rising. Twitter's hyped. But something feels off. No follow-through. No second wave. You don't buy. And 20 minutes later, it reverses violently. That was a bluff. The market flashed strength to flush you in, then punished your excitement. In poker, a bluff is profitable only when it tells the right story. In trading, the market bluffs when it knows your story and uses it against you. Most traders can't read the bluff because they're too busy chasing certainty. But SIG trains traders to watch sentiment like predators, to track behavior, to smell desperation, and most importantly, to stay still when the crowd gets loud. Bluff reading is not about being psychic. It's about knowing the game within the game. Here's the mind bender that changed everything for me. The best bluffs in poker aren't random. They're calculated to make you fold a better hand. Same in trading. The best market manipulations aren't about fooling everyone. They're about fooling enough people at the exact right moment. That whale dumping BTC, they're not trying to crash it. They're trying to trigger your stop loss so they can buy back lower. You're not watching price action. You're watching psychological warfare. Let me teach you something SIG traders know. The market has tells, just like poker players. Volume that doesn't match price movement. Wicks that appear at round numbers. Sudden news that coincidentally aligns with technical levels. These aren't accidents. They're orchestrated. Once you start cataloging these patterns, you'll spot bluffs before they happen. Share your favorite bluff indicator in the comments. Let's build a collective intelligence here. Pro tip from $1 billion desk. When everyone's excited, get suspicious. When everyone's scared, get interested. The market's best bluffs happen at emotional extremes, because that's when logic sleeps and instinct drives. If you want to decode bluffs, stop watching price. Start watching emotion. The chart shows what happened, the crowd shows what's about to happen. How often do you trade what feels strong instead of waiting for confirmation of intent? Have you ever bought a breakout only to be dumped on minutes later? That wasn't a bad trade. That was you reading a signal instead of reading a story. From now on, stop asking, is this bullish? Start asking, who would benefit if I believed this was bullish? And it wasn't, because every candle is a conversation. And if you learn to read the bluff, you stop being the one who gets played. Quick challenge that will sharpen your bluff reading skills forever. For the next week, before entering any trade, write down, who's on the other side of this trade and why are they taking it? If you can't answer with specificity, you might be the one getting bluffed. The market is a poker table. Every trade has a winner and a loser. Make sure you know which one you're positioned to be. But even if you can spot every bluff, even if you have perfect edge and infinite patience, there's one thing that can still destroy you, and it happens right after you think you've won. Chapter 4. When perfect setups fail. Why position? Sizing is the only real protection. You can play everything right and still lose everything. In poker, pocket aces are the dream, statistically the strongest starting hand. And yet, even pocket aces lose 20% of the time. That's 1 in 5 times you get crushed, even when you have the edge. In trading, it's the same. You spot the setup. Perfect breakout, high volume, clean structure. You size up, and then rug. Not because your analysis was wrong, but because your position size turned a small variance into a total disaster. It's like betting your life on a coin that lands heads 80% of the time. You're still dead 20% of the time. At SIG, one trader tells the story of his first college poker game, pocket twos. Excited, naive, he went in strong, lost everything in 10 minutes. But the lesson wasn't about the hand, it was about how much he risked. Because later, even with pocket aces, he learned to play small. Why? Because the one thing poker teaches you fast is this. Edge is not invincibility, it's probability. And variance doesn't care how confident you are. Let's bring it to trading. You're watching BTC form a clean ascending triangle, breakout. You're up 8%. You size in with your full account. Then the Fed releases surprise rate news. BTC dumps 12% in 15 minutes. Your account down 60%. Not because your setup was wrong, but because you confused edge with certainty. Most traders don't blow up because they're wrong. They blow up because they were right and overconfident. At SIG, even the best setups never warrant reckless size. Their internal mantra, never bet so much that one bad hand ends your career, because even the best setups still lose. And if you only survive when things go right, you're not a trader, you're a coin toss. In the WSJ Poker episode, a SIG trader shares a classic principle. Even if you've got pocket aces, you don't want your entire net worth on the table. Why? Because 1 in 5 times, those aces still lose. And no matter how good your hand is, your sizing decides whether you survive the loss. Let's talk about the math that most traders ignore until it's too late. If you lose 50% of your capital, you need a 100% gain just to break even. Lose 75%, you need 300% to recover. This is why SIG traders are obsessed with drawdown prevention, not profit maximization. The math of recovery is brutal and unforgiving. You don't blow up because of one bad trade. You blow up because you bet too big on it. Every amateur wants to find the perfect setup, but every professional knows it's not what you trade, it's how much you trade it with. Position sizing is the airbag of your trading vehicle. Without it, even a minor crash becomes fatal. Think of edge like a sharp blade, but without sizing discipline, you're swinging it without a handle. Sizing isn't just math, it's humility in action. When you size small, you're admitting, I could be wrong. I don't control variance. I care more about staying in the game than winning this hand. That mindset is what separates the grinders from the gamblers. In poker, this is known as bankroll management. In trading, it's your risk of ruin firewall. Every setup has its time, but every trade has to earn its size. Be honest, have you ever bet too big because the setup felt perfect? Have you ever doubled down, not out of logic, but out of certainty? Have you ever said, there's no way this fails? Then it failed. The market isn't here to validate your confidence. It's here to punish your overexposure. Drop a fire emoji if you've ever lost more than 20% on a perfect setup. No shame, just truth. Every pro has been there. The difference? They learn to separate edge from ego. From now on, use this rule of thumb. If a trade feels exciting, you're probably risking too much. Because real pros feel nothing when they click buy. It's just execution. The emotion is saved for discipline, not dopamine. Calculate what percentage you can lose per trade and still survive a 10-trade losing streak. If that number scares you, you're sizing too big. Share your maximum risk per trade in the comments. Let's see who's actually trading to survive versus trading to gamble. Story time. There's a famous SIG trader who turned $30K into $15 million. Want to know his secret? He never risked more than 0.5% per trade, ever. Even when he was up millions, even when he knew he was right. That discipline meant he could be wrong 200 times in a row and still trade. Most traders can't be wrong 5 times without blowing up. That's not a strategy problem, that's a sizing problem. But here's what happens even when you size perfectly. Eventually, you lose. Not because you did anything wrong, but because that's how probability works. And what happens next determines everything. Chapter 5, The Tilt Virus. Why your response to loss determines your survival. You didn't lose because of the trade. You lost because you couldn't walk away. Tilt is what happens after the loss, when logic goes quiet and emotion starts driving. It's the moment you start chasing the market, trying to get even, ignoring your plan, your edge, your rules. Tilt is not just a poker term. It's a trader's disease. And if you don't learn to recognize it, it will burn your account to the ground. Think of tilt like drinking after a breakup and texting your ex. You'll regret it, but in the moment, you don't care. In the WSJ Poker Roundtable, one trader shared a powerful insight. When we perceive ourselves as being in the losses, we're willing to do riskier things just to get back to even. Sound familiar? You've been there. That one red trade that shouldn't have happened. You watch your P&L bleed, and the voice in your head starts, get it back. Just one more trade. You open another chart, size bigger, force a setup, ignore risk. And by the time you snap out of it, you're down twice as much. SIG knows this. That's why they train traders like athletes. They don't just teach strategy, they teach emotional recovery, the art of recognizing the mental spin-out before it happens. They study tilt like a virus, because they know it's not the market that destroys you, it's your response to the market. Here's something most traders never realize. The market actually counts on your tilt. Market makers know that after a sharp move, emotional traders will chase. They position themselves accordingly. So, when you revenge trade, you're not fighting the market, you're feeding it. Every great trader knows how to lose. Only amateurs take it personally. The best poker players don't rage after bad beats. They log the hand, analyze it, move on. Because they understand, variance is part of the game. And the goal is not to win today, but to stay sharp enough to win over time. SIG reinforces this with daily review sessions. Traders aren't judged by win rate. They're judged by, did they stick to their process? Did they size appropriately? Did they avoid emotional revenge trades? Ask yourself, how do you respond to a loss? Do you take a break or take revenge? Do you journal or jump back in twice as hard? Because tilt isn't loud, it whispers. Double your size. Don't close yet, it'll come back. You're smarter than the market, but it's not your voice. It's fear, wearing confidence like a mask. And the only way to silence it is discipline built through fire. So, from now on, lose like a professional. Fold, reflect. Re-enter with clarity. Type tilt in the comments if you've ever given back a whole day's profit in one emotional trade. No judgment here. Recognition is the first step to recovery. Because here's the plot twist. The traders who admit their tilt patterns are the ones who eventually master them. The ones who deny it, they're the market's favorite customers. Fun fact that might blow your mind. Casinos make more money from tilted poker players than from the house edge. Think about that. The math favors them slightly, but human emotion, that's where the real money is. Same in trading. The spread might cost you 0.1%, but tilt, that'll cost you 50%. The biggest edge in trading isn't technical, it's emotional control. Quick pattern interrupt. You know what the best traders do after a loss? Nothing. Literally nothing. They have a rule. No trades for 24 hours after a max loss. Why? Because they know their brain is compromised, like a concussion protocol in sports. You don't play hurt, you heal first. Then you come back stronger. So, now you understand patience, edge, bluffs, sizing, and tilt. You're becoming dangerous, which is exactly when the market sets its most elegant trap. Because nothing destroys a good trader faster than becoming a confident one. Chapter 6. Short Stack Mastery. How to operate when you're behind. You can't fold forever. Eventually, you're forced to shove. Every trader, every poker player, eventually faces the short stack. You've taken losses. Your capital is thin. You can't afford many more mistakes. Now what? Most people panic. They either freeze or gamble. But SIG trains for this moment, because they know. The short stack doesn't mean you're dead. It just means your decisions must be perfect. Being short-stacked is like flying with low fuel. Every move must count. No showboating, no detours, no ego. WSJ's Jeremy Wien, longtime poker player and founder of a hedge fund, shared a hard truth. You're almost never going to win a tournament without, at some point, being down to 10 to 20 big blinds. In that zone, your margin for error is razor thin. You can't bluff just to bluff. You can't wait forever. You must act precisely, knowing you may still lose. But this is your only viable move. He called it the step function in his career, learning to play well under pressure, not just when he was ahead, but when he was on the brink. That's the real trader test. Not how you act at the top, but how you behave when the account is bleeding. Risk is not the enemy, recklessness is. When you're behind, you can't afford false setups, but neither can you afford inaction. You must find the right risk, the one with positive expectancy, even if the outcome is uncertain. SIG trains traders to think in terms of expected value, not emotion. A negative 30% drawdown isn't a death sentence, unless it causes you to panic, overtrade, and dig deeper. The mindset is, stay calm, reset parameters. Make the next trade clean, because all you need is one edge executed well, one win to get back momentum, one clean hand to double up. How do you behave when your account is red? Do you chase? Do you freeze? Do you self-sabotage? Have you ever dumped your system just because it wasn't working this week? Next time you're short-stacked, pause and ask, what is the highest EV move I can make right now, even if I only get one chance? That's not gambling. That's precision under pressure. That's the kind of courage that survives long enough to rebuild. Plot twist about being short-stacked? It's actually when you're most dangerous. Why? Because you have nothing to protect, no image to maintain, no streak to preserve. You become pure edge, stripped of everything else. Some of the best trades ever made came from traders with their backs against the wall. Not because they were desperate, because they were finally free from everything except logic. Here's a story about comebacks. One SIG trader went through a 40% drawdown early in his career. Instead of panicking, he reduced his position sizes to micro levels and focused only on his highest conviction setups. It took him 6 months to recover. But when he did, he had developed a psychological edge that no winning streak could have taught him. The ability to operate excellently under maximum pressure. That skill alone was worth the temporary pain. If you've survived a major drawdown, share your comeback story below. Sometimes the best traders are forged in the worst markets. Because here's what nobody tells you. The skills you develop while short-stacked become your superpowers when you're flush. The discipline, the selectivity, the emotional control. These aren't just survival mechanisms. They're the foundation of mastery, mental framework that changes everything. When you're short-stacked, you're not trying to get back to even. You're trying to make the next right decision. That's it. The scoreboard is irrelevant. The past is gone. All that exists is this trade, this moment, this decision. And paradoxically, when you stop trying to recover and start trying to execute, recovery happens naturally. But here's where most traders fall into the final trap. They survive the short stack. they rebuild, they start winning again. And that's exactly when they become most vulnerable. Chapter 7. The Winning Trap. How ego and success become your greatest enemies. You didn't blow up after a loss, you blew up after a win. Most people think failure comes after failure, but the most dangerous moment in trading isn't after a red streak, it's after a green one, because nothing inflates the ego faster than a lucky win, and nothing blinds a trader faster than the belief, I'm different, I get it now, I've cracked the code. Ego is like driving drunk on confidence. It feels good, right up until you crash. In poker, the player with the biggest stack often feels invincible. They start bullying the table, bluffing recklessly, chasing hands just because they can. But size without strategy is a trap. Just because you have chips doesn't mean you have control. In trading, it's the same. After a big win or a strong run, many traders confuse capital with clarity, and that's when they start risking more, breaking rules, abandoning patience. A full tank of gas doesn't make you a better driver. It just lets you crash faster. In the WSJ game with SIG traders, 1 point echoed again and again. You can make a bad decision and win, and you can make a great decision and lose. But ego doesn't care. Ego only sees the outcome. One trader shared how, in college, he won a massive pot with an objectively terrible hand. He felt like a genius, started pushing harder, bluffing bigger, taking reckless risks. 2 hours later, he was wiped. Why? Because his ego turned a lucky win into a license to play like a god. Now zoom into trading. You catch the breakout early, ride the pump, double your account, and then you start to believe it's you. Not timing, not market mood, you. And that's when you start skipping setups, abandoning sizing rules, trusting your gut. That's not intuition, that's ego with a TradingView account. In trading, your ego will convince you you're brilliant, right before the market proves you're human. At SAG, they systematically disarm ego. Every hand, every trade, every decision is debriefed with brutal honesty. There's no, I felt it. Only, was it edge? Was it repeatable? Was it rational? They train traders to separate skill from luck with surgical clarity. Because the moment you identify with your win, you stop learning. And when you stop learning, you start losing. Let me share something counterintuitive. At SIG, they actually celebrate small wins more than big ones. Why? Because small, consistent wins prove process. Big wins often prove luck. And process beats luck over decades. So next time you nail a huge trade, don't celebrate the outcome. Audit the decision. Was it really skill? Or did variance just smile at you? Near the end of the WSJ poker game, the journalist started picking up chips. And with every pot she won, she got bolder, confident. Then she bet it all in. She had a decent hand. But the SIG trader had a full house. The big stack was gone, just like that. I bet all of my chips, and ended up with nothing. That moment wasn't about cards. It was about psychology. She got attached to momentum, and the market punished her. Momentum makes you blind. Humility keeps you sharp. At AZG, having a big stack doesn't change behavior. They maintain process. They don't scale recklessly. They don't change the system because they're winning. Because they know. Size amplifies behavior. It doesn't fix it. If you're undisciplined small, you'll be dangerous big. To yourself. Think back to your last big win. Did it make you cautious? Or did it make you reckless? Did it make you more humble or more hungry to prove something? Have you ever raised your size just because you were on a streak? If yes, that wasn't growth. That was ego whispering. You're the exception. But here's the truth. There are no exceptions, only probabilities. And ego is the only variable the market never prices in because it always ends the same. Let's do a quick ego check. Think about your best trading month ever. Now, be honest. Did you get cocky? Did you start taking trades you normally wouldn't? Did you increase risk because you felt invincible? If you answered yes, you're human. But here's the thing. The market has a perfect memory for arrogance. It keeps a ledger of every ego-driven trade. And eventually, it collects with interest. Comment below with one rule you broke during a winning streak. Confession is the first step to prevention. True story that still gives me chills. A trader I mentored made 400% in 2021. Crypto bull run. Everything he touched turned gold. He quit his job, told everyone he'd figured it out. By March 2022, he was asking to borrow money for rent. Not because the market crashed, but because he'd learned to trade in easy mode and thought it was his genius. The market didn't take his money, his ego did. But even if you master your ego, even if you stay humble through success, there's still one more illusion waiting. The most dangerous belief of all, that what worked yesterday will work tomorrow. Chapter 8. The Future Fallacy. Why the past is a liar and adaptation is survival. What killed most traders wasn't the crash. It was believing it couldn't happen. Humans are wired to believe the future will look like the past. If something has gone up for weeks, we assume it will keep going. If a strategy has worked for months, we assume it's now safe. But markets don't work that way. And in both poker and trading, expecting repetition is a trap. It's like running toward a cliff because the road looks smooth so far, right up until it disappears beneath your feet. In the WSJ conversation, SIG's traders reference a painful moment from market history. The 2008 basis trade, when spreads that were supposed to move within 2 basis points exploded to 300 plus. Why did it happen? Because institutions assumed the relationship between two assets was permanent. They built models around it, leveraged them, bet billions. And then, the invisible thread snapped, everything broke, and so did the firms who believed the past was a promise. But SIG? They trained their traders differently, not to trust the current environment, but to constantly stress test it, to expect change, to always ask, what if this correlation breaks tomorrow? What if this setup stops working next week? What if volatility spikes out of nowhere? That mindset didn't just make them profitable, it kept them alive. Edge isn't permanent, it decays. Every winning strategy has a shelf life. Every trend ends. Every algo gets reverse engineered. The question isn't whether something works, it's how long before the market adapts and makes it stop working. That's why SIG doesn't marry systems. They monitor edge decay the way most traders monitor RSI, because they understand profit is temporary, adaptability is survival. Reality check from 2022. Everyone knew tech stocks only went up. Everyone knew crypto was the future. Everyone knew inflation was transitory. Then reality hit. Not gradually, all at once. The traders who survived weren't smarter. They just never assumed tomorrow would look like yesterday. They had plan B, C, and D, while others were writing eulogies for their accounts. Have you ever kept using a setup even after it stopped working? Have you ever stayed in a market phase because it worked before? Or held a stock just because it always bounces here? If so, you've experienced future fallacy, that subtle, dangerous belief that the market owes you consistency. But it doesn't. It only rewards those who adapt faster than the rest. Here's the paradox. The more successful your strategy, the faster it will stop working. Why? Because success attracts copycats, and copycats erode edge. That amazing arbitrage you found? Give it 6 months. That perfect indicator combination? The algos are already learning it. Your edge isn't just competing against the market, it's competing against everyone who's watching you win. From today, shift your mindset. Don't trust, don't assume. Observe, test, adjust. You're not betting on the market, you're betting on how well you can keep updating your beliefs. Instead of asking what will happen, start asking what could change. List 3 assumptions your current strategy depends on. Exchange rates, correlation patterns, volatility ranges. Now imagine each one breaking. How would you adapt? This isn't pessimism, it's preparation. Share one assumption your trading depends on in the comments. Let's stress test our collective blind spots. Because the traders who survive decades aren't the ones who predict the future. They're the ones who prepare for multiple futures. But here's the thing about survival. It's not just about avoiding blowups or adapting to change. It's about turning every experience, especially the painful ones, into fuel for improvement. Which brings us to the skill that separates good traders from legendary ones. Chapter 9. The Post-Mortem Protocol. How pros turn pain into profit. Every losing trader has a story. Every winning trader has a journal. Losing is inevitable, but learning is optional. The biggest difference between professionals and amateurs, it's not strategy, it's self-honesty. Amateurs explain away their losses. It was just bad luck. That candle was a trap. If the Fed didn't speak, I would have won. But pros, they sit with their mistakes. They break down every decision. Not because they enjoy the pain, but because they know the market gives you tuition. Your job is to collect the lessons. Postmortems are like flight crash investigations. Uncomfortable, but necessary if you ever want to fly safely again. In the WSJ Poker Roundtable, SIG traders laughed at players who rant about their bad beats, because that rant reveals something fatal. They're not learning. They're just venting. One trader put it like this: if they're talking about luck, they're not reviewing their decisions. That's a red flag. It means they're protecting their ego, not upgrading their mind. It's the same in trading. Most retail traders don't track their losses. They just emotionally move on. Or worse, try to win it back. But SIG, they turn every red trade into a training ground. Each mistake becomes a puzzle. What did I miss? Was my sizing justified? Did I tilt? Was I trading the setup or the emotion behind it? This isn't punishment. It's optimization. And it's what turns losing traders into lethal machines. Pain is a signal. Ignoring it is a decision. Most traders feel the sting of loss, but never trace its roots. They avoid the discomfort of reflection and pay for it in repeat mistakes. But top performers have a ritual. They log every trade. They write emotional state. They study not just what happened, but why it happened. Because they know every red trade is either a tuition fee or a donation, and they're done donating. Revolutionary idea from SAG. They don't just review losses. They review wins harder. Why? Because lucky wins teach the worst lessons. They reinforce bad habits with good outcomes. So every profitable trade gets the same scrutiny. Was this skill or variance? Would I take this trade 100 times? Did I follow my process or get lucky? That's how you build a system that works in all markets, not just the one that's being kind to you. When was the last time you printed out a losing chart and annotated every candle of your mistake? When was the last time you looked at your losses with zero excuses, just raw curiosity? Be honest. Are you more likely to review your winners or your losers? Here's what separates the pros. They treat every trade like a medical case study. Patient presented with these symptoms, treatment was administered, outcome was recorded, lessons were extracted. If you're serious about improvement, comment journal mode. Activate it and commit to logging your next 20 trades with brutal honesty. Personal confession. Early in my trading, I lost 5Ks in one day. Painful. But the real loss? I told myself it was market manipulation and moved on. 6 months later, lost another $5K the exact same way. Same setup, same mistake, same excuse. It wasn't until I finally did a real post-mortem that I saw the pattern. I was revenge trading after any loss over $500. The market didn't take 10K life from me. My blindness to my own patterns did. From now on, build your post-mortem ritual. After every loss, ask, was this a process failure or variance? After every win, ask, was this good decision-making or luck? Write it down. Because if you don't study your past, you're destined to repeat it at compound interest. But here's the ultimate truth about trading, poker, and life. You can do everything right, master every psychological trap, execute perfectly, and still face the one force that humbles everyone eventually. Chapter 10. The Variance Equation. A to source. How to think in decades, not trades. You didn't lose because your system failed. You lost because variance was doing its job. Most traders understand probability, but they hate variance. They want the win rate, but not the streaks of red. They want the edge, but not the part where even perfect trades lose. But SIG trains its traders to love variance, not emotionally, but mathematically. Because they understand, variance isn't your enemy. It's your business partner. Variance is like the ocean. You don't beat it. You build a boat that rides through it. One SIG trader in the WSJ game put it perfectly. In a single hand, the best player often doesn't win. But over thousands of hands, over hundreds of sessions, the better player always comes out ahead. That's the power of time-weighted edge. Trading is no different. You can do everything right. Identify the setup, size correctly, stay calm, and still take a loss. Why? Because the sample size is too small. Because edge doesn't guarantee the next trade. It guarantees long-term outcomes. At SIG, traders are trained to zoom out. Not to obsess over daily P&L, but over process fidelity, risk curves, and 10,000 trade trajectories. The market doesn't reward perfection. It rewards consistency through randomness. Variance is not noise. It's the cost of edge. The question isn't, did this trade work? It's, did I execute my edge cleanly? Would I take this trade again 100 times? Was this result within expected volatility? If yes, then loss or win, it was a good trade, because over time, the law of large numbers works in your favor. Final reality check. You know what separates SIG from retail traders? They expect to lose 45% of the time. They plan for it, budget for it, embrace it. While retail traders are trying to win 80% of their trades, SIG is trying to win 55% with perfect position sizing. Guess who makes more money? Guess who survives longer? Guess who sleeps better? The answer changes how you see everything. Be honest. How do you interpret variance? Do you see a losing streak as a sign that your system is broken? Or do you see it as a statistical necessity? Have you ever quit a good system after 3 to 5 red trades, only to chase a new one that feels better? If so, you're not reacting to logic. You're reacting to emotional discomfort with randomness. Let me leave you with this meditation on time. A coin that lands heads 51% of the time will make you rich if you flip it 1,000,000 times. But in any sequence of 100 flips, you might see 70 tails. That's not the coin being broken, that's probability being probability. Your job isn't to control the flips, it's to keep flipping when others quit, because in the end, the market doesn't care about your emotions, your stories, or your expectations. It only respects those who understand the deeper game. Here's the ultimate paradox. The more you accept variance, the less it affects you. The more you fight it, the more it destroys you. Because variance isn't personal, it's mathematical, and math doesn't care about your feelings. It only cares about sample size. So if you want to beat the market, stop trying to beat variance. Start trying to survive it long enough for edge to emerge. From today, start thinking in decades, not trades. Build systems that expect pain. Design risk profiles for streaks, not snapshots. And trust that if your edge is real, variance is your fertilizer. Comment. Variance accepted. If you're ready to play the long game, through all the noise and pain that comes with it. Installing the poker blueprint into your trading DNA. You've just walked through the same mental operating system that built one of the most lethal trading firms in the world. Let's recap what you've absorbed. You learned why folding 80% of the time is strength, not weakness. How to identify and defend your edge like a predator. Why the market bluffs daily, and how to read its tells. How position sizing is your only real protection against variance. Why tilt is the trader's virus, and discipline is the cure. How to operate under pressure when you're short-stacked. Why success and ego are your most dangerous enemies. How the past lies and only adaptation survives. Why studying your mistakes beats celebrating your wins. And above all, why variance is not your enemy, but your long-term dance partner. But now comes the real question. Will you leave these lessons on the screen, or will you install them like code into your trading DNA? Because you can read about edge, you can nod at sizing, you can agree with process over emotion, but if you don't practice it in real time, nothing changes. Drop a comment and tell me which of the 10 chapters hit you hardest and why. Was it tilt, position sizing, the winning trap, variance acceptance? But here's the twist. Don't just name it. Share a specific moment from your trading where that lesson would have saved you money. The more honest you are, the more this becomes real, for you, for others. Because we're all fighting the same psychological battles, just with different account sizes. Here's your challenge for the next 7 days. Log every trade and write down 4 things. Why you entered, how you sized, what emotion you felt, and what you learned, no matter win or loss. You don't need 100 trades, you just need 10 done with full awareness. Then come back and share your biggest discovery. What pattern did you find in your behavior that you never noticed before? Because this isn't about gambling anymore. This is about becoming the player the market fears most. The one who folds like a monk, sizes like a surgeon, waits like a sniper, learns like a scientist, and wins like a shark. Remember, you're not trading charts, you're trading decisions. And once you learn to think like a poker player, you stop playing the market and start playing everyone in it. The poker table is set, the chips are stacked, and the game never ends. The only question is, will you play like an amateur chasing every hand, or will you play like a professional waiting for your moment? Welcome to the Poker Blueprint. Let the game begin. And if this changed how you see trading forever, share it with one trader who needs to hear it, because the best players don't just win alone. They raise the level of the entire table. Until next time, this is Trading Psychology Stick, reminding you, the market rewards patience, punishes ego, and respects only those who master themselves first. Trade smart, trade humble, trade forever. Your brain is literally addicted to losing money, not metaphorically, not psychologically, neurologically addicted. MIT neuroscientists just proved what Wall Street has hidden for decades. The prospect of newfound riches triggers a surge in dopamine levels, generating excitement and pleasure, the exact same neural pathway as cocaine. But here's the plot twist that will change how you trade forever. The most successful traders on Wall Street, they have a genetic mutation. Two genetic alleles that affect dopamine are associated with success at trading stocks on Wall Street. They're not smarter, they're not luckier. Their brains are wired differently for one thing: moderate dopamine. Not high, not low, perfectly balanced. Welcome to Trading Psychology Stick, where we rewire your brain, not just your trades. Disclaimer: educational only, not financial advice. Trading is risky. Always do your own research. Before we dive deeper, I need you to do something. Look at your last month of trades. What percentage were losses? If it's above 30%, what you're about to learn could save your account. Comment below with just the number. No judgment, just data. The shocking reality check: 72% of day traders ended the year with financial losses, according to FINRA. About 70 to 80% of retail traders lose money. Only 1% succeed beyond 5 years. But here's what nobody tells you. It's not about eliminating greed. It's about redirecting it. In the next 50 minutes, you'll discover the 15 neural rewiring techniques that transform toxic greed into what I call strategic greed, the same mental framework used by the 1% who consistently profit. This isn't motivational fluff. This is hard neuroscience meets real trading data. These insights come from Stanford and MIT brain imaging studies on actual traders, analysis of 10,000 plus retail trading accounts, classified Wall Street genetic research, and my personal journey from blowing 3 accounts to managing 8 figures. What if I told you that your greed isn't the enemy? What if the very emotion destroying your account could become your greatest asset? What if the difference between the 90% who fail and the 10% who succeed is simply where they point their greed? By the end of this video, you'll never look at a chart the same way. You'll understand why every loss you've taken was neurologically predictable. And most importantly, you'll have a scientific blueprint to rewire your brain for consistent profits. From a neurochemical point of view, winning can have the same effect as an illegal substance. Your brain is already changing just from watching successful traders. The question is, will you let it change randomly, or will you take control? The clock starts now. Your transformation begins with understanding the first neural secret. You're about to discover why you keep making the same trading mistakes. These first 5 insights will make you realize you have a problem. More importantly, you'll understand it's not your fault. It's your biology. Insight number 1, the biological trading clock. Your brain becomes a financial predator at 3 specific times every day, hunting for the worst possible trades. Your greed isn't random. It follows a biological schedule as predictable as sunrise. Scientists discovered 3 critical periods when traders' brains betray them: the cortisol crash at 4 a.m., the sugar collapse at 2 p.m., and the loneliness loop from midnight to 2 a.m. During these windows, your ability to assess risk drops by up to 70%. Let me tell you about the London whale. Not the headlines you read, but what actually happened in those trading rooms. Bruno Ixel, the trader who lost JP Morgan $6.2 billion, had a pattern nobody talked about. Internal records showed 73% of his position increases happened during 2 windows, 4 to 5 a.m. London time and 2 to 3 p.m. 4 a.m. London, Ixel's at his desk. The cortisol that should protect him from bad decisions, at its daily minimum. His brain interprets this depletion as calmness, clear thinking, but it's the opposite. It's vulnerability. He sees the futures moving. His depleted brain can't differentiate between opportunity and noise. He adds to his position, then adds again. Each addition feels rational in his cortisol-starved state. By the time New York opens and his cortisol normalizes, he's built a position so large it would take months to unwind. But here's the kicker. He did this pattern for 180 days straight. Same times. Same biological blindness. The 2 p.m. phenomenon was equally destructive. Post-lunch, blood sugar crashes. The brain seeks stimulation. For a derivatives trader, that stimulation comes from one place: bigger positions. Quick test for you: pull up your trading history right now. Seriously, do it. Look at your biggest losses. What time did they occur? I'm betting over half happened at 4 a.m., 2 p.m., or midnight. CME data backs this up. The 4 a.m. hour has 400% more retail losses than any other period. It's not the market. It's the mismatch between human biology and market hours. Mike Bellafiore from SMB Capital documented this with his traders. One consistently profitable trader became consistently unprofitable just by taking the London session. Same strategy, same setups, different biological state. His solution? He now trades only 9:30 a.m. to 11:30 a.m. New York time. His win rate jumped from 35% to 67%. Nothing changed except respecting his biological prime time. The professionals don't fight biology, they map it. They know their danger zones and either avoid them completely or use predetermined automated strategies during these periods. Track your losses for a month. What time did they occur? You'll likely find a pattern that matches your biological rhythm. Are you trying to be a hero by trading when your brain is the villain? What if you only traded during your biological prime time? What if respecting your neural limitations was the edge you've been searching for? Your 24-hour challenge. Tomorrow, mark your danger zones. Red blocks on your calendar. Don't trade during them. Just once. See what happens. But biological timing is just the beginning. The next trap is even more seductive because it happens when you're winning. Insight number 2, the winner's curse phenomenon. Your biggest win is statistically your most dangerous moment as a trader. Imagine your brain as a nightclub and dopamine as the DJ. When you hit a big win, that DJ cranks the volume to 11. The prospect of newfound riches triggers a surge in dopamine levels, generating excitement and pleasure. The party is incredible for about 72 hours. Then comes the crash nobody warns you about. Jesse Livermore knew this pattern intimately. The man who made $100 million in 1929, equivalent to $1.5 billion today, also went bankrupt 4 times. Each bankruptcy followed the same pattern: massive win, dopamine flood, reckless decisions, total destruction. His journals, studied by behavioral economists, reveal the cycle. After shorting the 1929 crash successfully, he wrote, "I feel invincible, like the market speaks directly to me." Within 90 days, he'd given back 90% of his profits. But the modern version is even more brutal. Remember GameStop? January 2021, a software engineer posted his $5,000 to $150,000 transformation on Reddit. 3 days, 2,900% return. The screenshots went viral. His brain was experiencing a dopamine surge scientifically measured to exceed winning the lottery. His Reddit posts tell the story. Day 1 after the win. I've cracked the code. Matrix vision activated. Day 3. Putting everything into the next play. Why settle for 150K when I can hit $1 million? Day 7. YOLO'd into 5 different meme stocks. Day 21. Account at 0. His final post was haunting. I don't understand. I felt smarter than ever. Every trade looked perfect. That's the curse. He wasn't seeing clearly. He was seeing through dopamine goggles. Every setup looked amazing because his brain needed more action to maintain the high. Pause the video for 10 seconds. Think about your biggest win ever. What happened in the next 30 days? Type yes. If that account eventually blew up, you're about to understand why. Brain scans from Northwestern University show winners' dopamine receptors literally burn out, like speakers pushed too hard. What happens next is predictable. You need bigger trades, bigger risks, bigger wins just to feel normal again. 73% of accounts blow up within 30 days of their biggest win. It's not karma, it's chemistry. The professionals know this. Ray Dalio's Bridgewater has mandatory cooling-off protocols. Win more than 5% in a day, you're done. Computer locks you out, not as punishment, as protection. Paul Tudor Jones goes further. His best days are followed by his smallest position sizes. I trade inverse to my confidence, he says. When I feel like a genius, I trade like an idiot. Small, careful, suspicious of my own brain. Think back to your biggest winning streak. Remember that feeling of invincibility? The voice saying you finally figured it out? That wasn't confidence. That was your brain on dopamine overdose. What if your best trades happened not when you felt like a genius, but when you felt neutral? What if the secret to consistent profits was treating big wins like dangerous drugs? Amazing in small doses, deadly in large ones. The winner's curse is powerful, but at least it's obvious. The next trap is so subtle, most traders don't even know it exists. Insight number 3, the reality distortion field. Every profit screenshot you see literally damages your brain's ability to assess reality. Then your own floating profits finish the job. Two forces combine to create what I call the reality distortion field. External social proof warps your expectations. Internal phantom profits warp your perception. Together, they create a hallucination more powerful than any drug. Long-term capital management proved this on a massive scale. Nobel Prize winners, literal geniuses, 40% annual returns. Their reality distortion was so complete, they leveraged 200 to 50 to 1. John Meriwether, LTCM's founder, later admitted, "We stopped seeing risk. We only saw our models, our returns, our reputation. Reality became whatever confirmed our genius." But here's what happened in their offices, according to employees. The partners would start each day reviewing their positions. Up 10 million, up 50 million, up 100 million. These weren't realized gains, just numbers on screens. But their brains didn't distinguish. They'd spend phantom profits in their minds. New houses, philanthropy, legacy building. The unrealized gains became more real than reality. Then came social proof. Every financial magazine featuring them. Every competitor copying them. Every investor begging to give them money. The external validation made their internal delusion feel like truth. August 1998. Russia defaults. Their positions move against them. But they can't see risk anymore. They see temporary setbacks. Buy more. Leverage more. Reality will bend to their will. It didn't. $4.6 billion lost in 4 weeks. The Fed had to coordinate a bailout to prevent global collapse. These weren't idiots. They were victims of reality distortion at industrial scale. But it happens to retail traders every day. During the 2021 crypto bull run, I watched it destroy thousands. A trader sees Shiba Inu moonshots on Twitter. 1,000 to 1 million in days. His brain accepts this as normal, possible, expected even. He buys. Price goes up, unrealized profit, $10,000. His brain immediately owns this money, spends it, depends on it. Price pulls back to 8,000 profit. He hasn't lost anything. But his brain screams theft. Someone stole $2,000. He checks Twitter, more screenshots, more millions. His 8,000 feels like poverty. The combination of phantom loss and social proof creates unbearable pressure. He doubles his position, then triples it, not from analysis, from distortion. He's not trading reality anymore, he's trading the hallucination. Comment below. How many times have you held a winner too long after seeing someone else's bigger profits? How often has social media turned your winning trade into a feeling of failure? Research with 807 experienced traders proved the danger. Investors presented with upward social comparison take more risk, trade more actively, and report significantly lower satisfaction with their own performance. Your brain treats unrealized gains as real money. Loss aversion makes every pullback feel like theft. Add social proof showing bigger wins, and you get a cocktail of delusion. The cure is brutal but simple. Hide your P and L. Unfollow profit screenshots. Judge trades only by process, not by the highest point they reached. Reality distortion warps your judgment, but at least it's visible. The next trap is so gradual, you won't notice until it's too late. Insight number 4, the lot size creep. Your position size doubles every 60 days, and you don't even notice. Average position size increases 400% in the 60 days before account destruction. This isn't sudden gambling, it's gradual normalization. Your brain adapts to risk like eyes adapt to darkness, slowly, then all at once. 2 stories, same pattern, different zeros. First, Nick Leeson, started as a clerk at Barings Bank, worked his way to trader. His destruction of the 233-year-old bank didn't begin with massive bets. It began with one small unauthorized trade. Internal records revealed during the investigation show the progression. Month 1, hides a 20,000-pound loss. Manageable. Month 2, Unauthorized trades reach £200,000, still recoverable. Month 6, £10 million. Brain completely normalized. Month 14, £827 million, twice the bank's capital. Leeson later wrote, "Each increase felt small compared to the last size. My brain couldn't see the absolute madness anymore." Second story, Jérôme Kerviel at Société Générale started with a €100,000 position he wasn't supposed to take. It worked. The dopamine hit was real. The progression was documented in court. Week 1, €100,000. Week 4, €1 million, just 10x. Reasonable, his brain said. Week 12, €30 million, another small multiple. Week 50, €50 billion, larger than the bank's market cap. His manager testified, "If you showed me the 50 billion position on day 1, I'd call security. But we got there one step at a time. Each step felt normal." But this isn't just about rogue traders. It's about you. Pull up your trading history right now. Compare your average position size from 6 months ago to today. Don't look at percentages. Look at actual dollar amounts. Type guilty if they've more than doubled. The mechanism is always the same. You start disciplined. 0.01 lots. Proper risk management. But wins make you comfortable. Comfortable becomes confident. Confident becomes reckless. Week 2, just this once becomes 0.02 lots. Month 2, 0.05 is the new normal. Month 3, 1.0 lots on high conviction trades. Month 4, margin call. Your brain has a feature called hedonic adaptation. It's why millionaires don't feel rich and why your new car excitement fades. The same mechanism makes yesterday's big position feel small today. The only defense is external controls, hard stops on position size, maximum daily risk that can't be overridden, software that prevents you from increasing size without a cooling off period. Successful traders don't trust their future selves. They know their brains will betray them. They use technology to enforce the discipline their minds will abandon. What if you hard-coded your position sizes? What if increasing size required a 48-hour waiting period? What if you protected yourself from yourself? Position size creep happens slowly. The next trap happens in exactly 90 seconds. Insight number 5. The revenge trading cascade. You have exactly 90 seconds after a loss before your brain declares war on your account. Victor Niederhofer learned this the hard way, twice. The legendary trader who turned 40,000 into 20 million had one fatal flaw. He couldn't accept losses. October 27, 1997. Niederhofer is short puts on the S&P. The market gaps down. His losses hit 50 million, more than he has. Here's what happened in those crucial 90 seconds, according to his own account. Seconds 1 to 30. Disbelief. This can't be happening. The market will bounce. Seconds 31 to 60. Rage building. The market is wrong, manipulated, rigged against me. Seconds 61 to 90. The transformation. Rational, Victor dies. Revenge, Victor emerges. He could have closed, taken the loss, lived to trade another day. Instead, he doubled down, then tripled, fighting the market like it was a personal enemy. By minute 15, he'd turned a survivable loss into complete destruction. Wiped out. Zero. The man who'd beaten the market for 20 years, destroyed in 15 minutes of revenge. But here's the kicker. He rebuilt, made it all back. Then in 2007, the exact same pattern. Loss, 90 seconds, revenge, zero. He later wrote, "Both times I knew within 90 seconds I was about to do something stupid. But I couldn't stop myself. It was like watching someone else trade my account. Set a timer right now. 90 seconds. That's how long you have after your next loss before your brain becomes your enemy. Screenshot this and save it." Neuroscience shows after a loss, rational thought decreases 70% within 90 seconds. Your prefrontal cortex, the CEO, goes offline. What remains is a wounded animal seeking vengeance. Low dopamine levels during the ensuing bust may have led to heightened risk aversion, causing some investors to miss subsequent lucrative opportunities. But that's just phase 1. Phase 2 is worse. Your depleted dopamine creates desperation that manifests as revenge. The cascade is predictable. Loss occurs. Brain personalizes it. The market took my money identity threat. I'm not a loser. Revenge fantasy. I'll get it back right now. account destruction. Professional traders have mandatory loss protocols. Paul Tudor Jones. After any loss over 2%, I'm done for the day. Period. Computer locks me out. Ray Dalio goes further. Loss equals reflection time, not trading time. 1 hour minimum before I can even look at a chart again. They understand something crucial. Future you, 90 seconds after a loss, is your worst enemy. That person will destroy everything current you has built. When was your last revenge trade? Can you identify the exact second rational you died? Type the number of revenge trades you've taken this month. No judgment, just awareness. What if you had an accountability partner whose only job was to call you 60 seconds after any loss? What if those 90 seconds were protected by systems, not willpower? These 5 insights have shown you the problem. You're fighting biology, chemistry, and psychology with nothing but hope. Now let's dive deeper into why your brain betrays you. Now you know you have a problem. These next 5 insights will reveal why your brain is wired for trading failure. More importantly, you'll discover that some traders have found ways to hack their biology. Insight number 6, the dopamine trading genetics. Wall Street's dirty secret: the best traders are genetic mutants. 2 genetic alleles that affect dopamine are associated with success at trading stocks on Wall Street. This isn't inspiration, it's biology. Successful traders don't have more discipline. They have different DNA. The study was buried for years. 2008, Manhattan. Neuroscientists arrive at a major trading firm, not to study strategies, to study spit. 60 professional traders, all profitable for at least 5 years, provide DNA samples. The control group, 54 MBA students, smart, ambitious, but not traders. The results changed everything we thought we knew about trading success. The traders shared specific genetic markers. The COMT gene, MET158 variant. The DRD4 gene, 7 repeat allele. These aren't intelligence genes, they're dopamine regulation genes. Traders with the Warrior COMT gene variant process dopamine 40% slower. When markets spike, when volatility explodes, when everyone else is flooded with excitement or fear, these traders feel curious. One trader in the study, profitable through 2008's chaos, described it. When Lehman collapsed, my colleagues were screaming, panicking. I felt like I was watching a movie, interesting, worth analyzing, but not personal. His DNA test confirmed it. Double Warrior variant. His brain literally couldn't produce the same panic response. But here's what matters for you. The study found something else. Traders without the genetic advantage who survived had developed workarounds. They didn't change their genes. They changed their triggers. Type dopamine junkie. If big green candles make your heart race, if market moves feel personal, if winning makes you high and losing makes you sick, that's normal genetics, not trader genetics. The genetic elite don't feel less. They feel differently. Dopamine plays a bigger role in the motivation for the reward than in the actual reward itself. They get their hits from process, not profits. Think about it. What if you could train your brain to crave perfect execution regardless of outcome, following rules when it's hardest, identifying setups correctly, win or lose, honoring stop losses like victories? Stan Druckenmiller, not part of the study but tested privately, has the mutation. He describes trading as solving puzzles. Wins and losses are just data points. The puzzle is what matters. You can't change your DNA, but you can change your dopamine sources. Professional traders have rewired their reward systems. Brain scans show they process successful trades and perfect stop losses in the same neural region. What gives you a dopamine hit? The green P and L being right, or the craft itself? Your genetic reality check. Starting tomorrow, celebrate one perfect stop loss like you would a winning trade. Share it, journal it, feel proud of it. Train your brain that discipline delivers dopamine. But even perfect genetics won't save you from the next trap. Insight number 7, the strategy hopping syndrome. The turtle traders were given the exact same rules. 13 became millionaires, 10 blew up. Same system, different brains. Richard Dennis wants to prove trading can be taught. He recruits 23 people, gives them exact rules. The turtle trading system. Simple trend following. Clear entries, exits, position sizing. No interpretation needed. The results should have been similar. They weren't even close. Curtis Faith, the youngest turtle at 19, made $31.5 million. He followed the rules through 11 straight losses, 22% drawdown, never wavered. Another turtle, with the same rules, same capital, same markets, lost everything in 3 months. The postmortem revealed why. He couldn't stick to one system. Loss. Endidispeaks. 1. Maybe I misunderstood the rules. Loss 2. The markets have changed since Dennis created this. Loss 3. I'll just adjust the parameters slightly. Loss 5. Abandons the system entirely. This is strategy hopping syndrome. Your brain, especially if you have the novelty-seeking DRD4-7R gene variant, gets high from new strategies. You're not addicted to trading success. You're addicted to the search for success. Dennis later said, "The turtles who failed weren't dumb. They were human. Humans want to improve things. Markets punish improvement. They reward consistency." Modern data is even more damning. A study tracking 10,000 retail traders found the average trader tries 12 different strategies per year. The profitable 1%, they average 1.3 strategies. For years. Type the number of strategies you've tried this year. Include every system, indicator, guru method you've tested. Be honest. Here's the brutal truth. Every strategy works sometimes. No strategy works all the time. The difference between winners and losers isn't finding a better strategy. It's sticking with a good enough strategy through its drawdowns. Mark Minervini, who turned 30,000 into over 30 million, uses basically the same strategy he developed in the 1980s. I've refined it maybe 5% over 30 years. Consistency beats complexity. Your brain will fight this. It wants novelty. It wants to feel smart. It wants the dopamine hit of discovering something new. That's not trading. That's gambling with extra steps. The cure is commitment. Choose one approach. Define its rules precisely. Track 100 trades minimum before even thinking about changes. Your edge isn't in the perfect strategy. It's in perfect execution of an imperfect strategy. What if success isn't about finding a better system? What if it's about becoming better at the system you have? Strategy hopping kills accounts slowly. The next insight shows how success can kill them quickly. Insight number 8. The plateau trap. LTCM's Nobel Prize winners averaged 40% returns for 4 years. Then they lost $4.6 billion in 4 weeks. Success was their destruction. The plateau trap is insidious because it feels like progress. Small, consistent wins, growing confidence, expanding comfort zone, then sudden catastrophic failure. Long-term capital management was the perfect case study. Founded by John Meriwether, staffed with Nobel laureates Myron Scholes and Robert Merton, the smartest guys in any room. Year 1, 21% return, respectable. Year 2, 43% return, exceptional. Year 3, 41% return, consistent. Year 4, 17% return, in 5 months. Then, August 1998 happened. But here's what the news didn't report. Internal memos show the real killer wasn't Russia defaulting. It was the plateau trap. 4 years of success had rewired their brains. Risk models that screamed danger were overruled. Position sizes that once seemed insane felt conservative. Leverage of 25 to 1 became 250 to 1. Partner Victor Hagani later admitted, "We confused a good run with genius. Every month of profits made us feel more invincible. By year 4, we weren't trading markets. We were trading our own mythology." The plateau trap has 3 stages. Competence, you develop real skill. Confidence, success reinforces your methods. Complacency, your brain stops questioning. Stage 3 is lethal. Your prefrontal cortex, exhausted from years of vigilance, takes a vacation. You stop checking your blind spots. Stop questioning your assumptions. Stop respecting the market. After your best month ever, what happens next month? Comment bigger if you size up. Comment careful if you size down. Comment same if nothing changes. The data is terrifying. Traders who have 6 straight winning months have an 82% chance of a major loss in month 7. Not because they get worse, because they feel invincible. Paul Tudor Jones knows this. His famous quote, "I'm always thinking about losing money as opposed to making money." This isn't pessimism, it's plateau prevention. After his best periods, he deliberately shrinks. Smaller positions, tighter stops. Assume the worst. When I feel like a genius, that's when I'm most dangerous to myself. The antidote is systematic humility, scheduled reality checks, position size limits that decrease with success, not increase. Treat winning streaks like loaded weapons. Useful, but dangerous. Your plateau trap warning: if you've had 3 winning months, you're entering the danger zone. Your brain is rewiring for overconfidence. What safeguards will you install before it's too late? The plateau trap seduces you with success. The next trap seduces you with chaos. Insight number 9. The news gambling trap. News trading isn't trading. It's Russian roulette with spreadsheets. January 15th, 2015, 3:30 a.m. New York time. The Swiss National Bank announces they're removing the EUR-CHF floor. What happened next destroyed thousands of accounts in under 4 minutes. The franc moved 30% instantly. 30% in a major currency in seconds. Retail traders positioned for easy money saw this. 3:29 a.m. account value 50,000. 3:33 a.m. account value negative 170,000. Yes, negative. They didn't just lose their money, they owed their broker 170,000. FXCM alone reported 225 million in client negative balances. Alperi UK went bankrupt. Retail traders received legal notices demanding payment for losses exceeding their entire net worth. But here's what's crucial. Every one of these traders thought they were smart. The EUR-CHF floor was guaranteed by the Swiss National Bank. Free money? Until it wasn't. Type your biggest news trading loss. Just the number. If you've never traded news, type SMART. During major news, your analytical brain goes offline. Data shows win rates during NFP and FOMC plummet to 35%. You're not trading news. You're feeding your brain's need for chaos. Your brain on news releases is your brain on cocaine. Same regions activate. Same dopamine flood. Same inevitable crash. The only difference? Cocaine is cheaper. Here's what happens in your brain during NFP. Minus 60 seconds, anticipation. Cortisol rising, minus 30 seconds, adrenaline spike, hands shaking, release, dopamine explosion, time distortion. Plus 30 seconds, cognitive blindness, can't process. Plus 5 minutes, exhaustion, regret, confusion. Professional news traders don't trade the news. They trade the reaction to the reaction. Tom Dante, legendary Forex trader, waits minimum 30 minutes after any release. Let the addicts blow up first, then trade the exhaustion. The data is undeniable. Retail traders who avoid news completely outperform news traders by 340% annually. It's not about missing opportunities. It's about avoiding guaranteed destruction. But your brain doesn't want to hear this. It wants the action, the excitement, the possibility of instant riches. That's not trading. That's gambling with a Bloomberg terminal. What if news releases became your scheduled break time? What if you treated high volatility like a tornado? Something to shelter from, not chase. Your news trading audit: calculate every penny made or lost on news trades. Include the revenge trades after, the FOMO entries. Is it profitable or expensive entertainment? News trading feeds chaos addiction. The next trap feeds a different addiction entirely. Insight number 10. The stop-loss psychology. Traders who've never let a stop-loss hit are 500% more likely to blow their accounts. Paul Tudor Jones has a saying, "Losers average losers." But the psychology behind why traders can't take losses goes deeper than ego. It's about neural wiring. Jesse Livermore learned this through pain. His early career was marked by an inability to take losses. He'd move stops, delete them, add to losers. His first bankruptcy came from one trade he couldn't admit was wrong. But Livermore evolved. By his peak, he was famous for hair trigger stops. He'd enter with 10,000 shares and exit with a 10-cent loss if it moved against him. $1,000 loss. Next trade. A reporter asked why he took such quick losses. His response: "I can always get back in. I can't always get my money back." This evolution from stop-loss hater to stop-loss lover is what separates the 99% from the 1%. But most never make the transition. Berkeley research revealed why. Brain scans show amateur traders process stop-losses in the same region as physical pain. Professional traders, they process stop-losses in the reward center, same as winning trades. How many stop-losses have you moved this month? Type the number. If it's above zero, you're trading with an amateur's brain. Mike Bellafiore from SMB Capital tells this story about every new trader. They come in disciplined, but they have a secret. They've never actually let a stop hit. Their discipline is just good luck. First real stop loss approaching. The excuses begin. News in 20 minutes. This is just a shakeout. I'll give it more room. They move the stop. Disaster follows. Not always immediately. Sometimes it works, which is worse. Now they've trained their brain that stops are negotiable. The professional mindset is radically different. They celebrate stop losses. Literally. Linda Raschke posts her stop outs with pride. Perfect execution. Saved 3% by honoring my stop. To her, a stop loss isn't failure. It's data purchase. She paid a small price to learn the trade was wrong. Without that data, she might have paid a large price. Think about it. A stop loss is just admitting you're wrong for a small fee. Moving a stop is insisting you're right for a large fee. Which trader survives long term? Your stop loss revolution starts now. Your next clean stop loss, share it like a winning trade. Feel proud. You just did what 90% of traders can't. You admitted you were wrong cheaply. Stop losses reveal character. Demo trading reveals even more. You understand the problems. You know why your brain betrays you. Now discover your path from the 99% to the 1%. These final insights show you how to evolve. Insight number 11. The demo to live shock. Same person, same strategy. 68% win rate in demo, 31% in live trading. The cruelest joke in trading. Demo success predicts live failure. The better you do in demo, the harder you'll fall in live. Northwestern University proved why. Different money, different brain. Every prop firm sees this pattern. SMB Capital's data is typical. Demo phase. New traders average 65% win, rate week 1, live, 45% win, rate month 1, live, 31% win, rate month 3, live, 90% washout. Same people, same setups, same markets, different results. Why? Brain scans reveal the shocking truth. Demo trading activates your logical centers. Live trading with real money? It activates survival circuits that predate language. You're not the same person anymore. One trader's journey documented in detail. 6 months demo, 10,000 to 47,000. Consistent, mechanical, confident. Day 1, live with 10,000 real dollars. Can't pull the trigger. When he finally does, position size is 1/10 of demo. Wins feel tiny, losses feel massive. Week 1, up $100. In demo, would be up 2,000. But this 100 feels monumental. He starts over trading to make real money. Week 2, first real loss, $500. In demo, meaningless. In live, chest pain, literal physical pain. That's groceries, that's rent, that's real life evaporating. Month 1, account at 7,800. Not from bad trades, from scared trades. Late entries, early exits, moved stops, death by fear. Who here crushed demo but struggled live? Type me. You're about to learn why this is biology, not psychology. Real money activates your amygdala, the fear center. This hijacks your prefrontal cortex. You can't think clearly because you're not designed to. Your brain treats financial loss like physical threat. It's to use it correctly. Demo is for testing systems, not building confidence. Real confidence only comes from real losses with real money. Start live with amounts so small they bore you. $10 trades, $20 trades. Build your real money neural pathways slowly. Your brain needs to learn that financial loss won't kill you. Professional traders know this. They fund new traders with tiny amounts first, not to limit losses, to build proper neural patterns. Only when you can trade $100 like demo can you trade 1,000. Only when you can trade 1,000 like demo can you trade 10,000. What if you started over? Not with your strategy, but with your psychology. What if you built your live trading brain as carefully as you built your system? Demo trading reveals one gap, the next reveals another. Insight number 12, the time frame confusion. George Soros said, "I only have one time frame, the right one." Most traders have 5 time frames, all wrong ones. Checking multiple time frames doesn't make you thorough. It makes you schizophrenic. Each time frame activates different neural circuits. Your brain literally can't process conflicting signals. It just picks the one that confirms what you want. Eye tracking studies at the University of Chicago prove it. Traders looking at multiple time frames don't analyze. They cherry pick. Their eyes spend 73% more time on time frames that support their bias. Here's what happens in every trading room, every day. A trader sees a perfect daily setup. Clear trend, clean structure, about to enter. Then the doubt, better check multiple time frames. 4 hour, confirms the daily. Good. 1 hour, sideways. 15-minute, complete opposite signal. 5-minute, chaos. Now their brain is broken. 5 different stories playing simultaneously. The original edge on the daily is forgotten. Analysis paralysis sets in. Hours later, the daily setup plays out perfectly without them. 300 pips missed because they wanted to be thorough. How many time frames are open on your screen right now? Count them. Type the number. If it's more than 2, you're sabotaging yourself. Paul Tudor Jones trades 1 time frame. Period. I found my edge on the daily chart in 1987. Still using it. Why would I confuse myself with noise? George Soros was more philosophical. The market has many time frames, but only one truth. Find the time frame that shows truth most clearly. Ignore the rest. Professional traders have a saying, 1 time frame, 1 story, 1 decision. They understand something neuroscience proves. The human brain evolved for single-threaded thinking. Multitasking is a myth. Multi-time frame analysis is worse. Your brain, faced with conflicting signals, doesn't average them. It picks the one that confirms your emotional bias. Always. You think you're being analytical. You're being manipulated by your own mind. The solution is radical simplicity. Pick 1 time frame. Master it completely. Know its rhythms, its fake-outs, its personality. Other time frames aren't confirmation, they're confusion. What if mastery of one beat mediocrity at many? What if depth beat breadth? What if simplicity beat complexity? Your time frame challenge. Trade only your primary time frame for 30 days. No peeking at others. Watch what happens to your clarity and your results. Time frame confusion comes from trying to see everything. The next trap comes from trying to be someone else. Insight number 13. The mentor mirage. Why do 90% of people who buy trading courses fail? It's not the course, it's the copying. Timothy Sykes starts posting every trade, complete transparency, exact entries, exits, reasoning. Thousands buy his alert service. The results? 5% make money, 95% lose. Same alerts, same stocks, same timing. One subscriber, Michael Good, turns a 1,500 into 1 million. Another subscriber, same period, loses 50,000. They're receiving identical information. What's different? Good understood something the losers didn't. You can't trade someone else's personality. He took Sykes' patterns and adapted them. Different position sizing for his risk tolerance. Different times for his schedule. Different exits for his psychology. The losers? They tried to be Sykes, trade exactly like him. Same size relative to account, same holding periods, same everything. It's like wearing someone else's prescription glasses and wondering why you can't see. The turtle traders proved this decades earlier. Richard Dennis gave 23 people the exact same rules, not guidelines, rules. Precise entry signals, exact position sizing, clear exits. 13 became millionaires, 10 blew up. The difference? The successful ones translated the rules through their personality. They followed the system, but traded like themselves. The failures tried to trade like Dennis. Same actions, wrong person. Have you ever bought a course or signal service? Type yes or no. If yes, did you try to copy exactly or adapt to your style? Your brain isn't wired like your mentors. Different genetics, different fears, different life experiences. Copying someone else's trading is like trying to copy their walk. You can mimic the movements, but it'll never feel natural. Mirror neurons make us think we can copy success, but trading success requires personal neural pathways, not borrowed ones. You need your own relationship with risk, your own pattern recognition, your own emotional management. Ray Dalio learned this early. He studied every great trader, tried to copy them, failed miserably. I was a bad version of them instead of a good version of me. His breakthrough came when he stopped copying and started translating. Take the principle, not the practice. Understand why something works, then apply it your way. The mentor mirage is seductive. Someone else has figured it out. Just copy them. But that's not how brains work. That's not how success works. What if instead of trying to trade like your hero, you learned from your hero how to trade like yourself? What if the goal wasn't to copy, but to discover? Your evolution requires you to stop being a bad copy and start being a good original. But first, you need to make trading real. Insight number 14. The withdrawal psychology. Traders who never withdraw profits have already lost. They just don't know it yet. Two brothers in Australia. Same starting capital, $5,000. Same strategy, same mentor. One crucial difference changed everything. Brother A. Never withdraw, compound forever. Think big. Brother B. Withdraw 50% of profits monthly. Trading must pay me. Year 1 results. Brother A. Account at $25,000. Never withdrawn a penny. Brother B. Account at $12,000. Withdrawn $11,000. Brother A mocks his sibling. You're killing your compound growth. That $11,000 could be $50,000 next year. Brother B shows his new car. Paid cash. This is real. Your numbers are pixels. Year 2, month 6, crypto flash crash. Brother A sees his $45,000 become $8,000 in one day. The psychological damage is severe. 2 years of work, gone. He enters depression, stops trading. Brother B takes the same percentage hit. Account drops to $4,000, but he's withdrawn $27,000 over 2 years, still up $23,000 overall. He keeps trading. Today, Brother A works a corporate job, bitter about markets. Brother B trades full-time. His withdrawals bought a life that supports his trading. His trading supports his life. Have you ever bought anything with trading profits? Type yes or no. If no, you're playing a video game, not building wealth. Never withdrawing creates dangerous psychology. Nothing feels real. Wins don't satisfy because they're just numbers. Losses don't teach because they're just pixels moving. Data shows traders who never withdraw treat accounts as play money. They take 250% more risk. Their brains never connect pixels on screen to purchasing power in reality. Mark Douglas understood this. He forced his students to withdraw monthly. If your trading can't buy a coffee, you're not a trader. You're a gambler with a spreadsheet. The brain needs tangible feedback loops. When trading profits buy actual items, neural pathways strengthen between good trading and life improvement. The abstract becomes concrete. Professional prop traders have mandatory withdrawal schedules, not optional, required, because firms know that traders who don't withdraw eventually blow up. They need to feel the reality of their success. What changes when you buy your first meal with trading profits? Your first bill? Your first vacation? Everything. Because now it's not a game, it's a profession. Your withdrawal challenge. Next profitable month, withdraw something. Anything. $50, $500. Make trading pay you. Feel the difference between pixels and prosperity. But where does this all lead? What's the end game of this journey? Insight number 15. The evolution ladder. Your trading journey has 5 predictable stages. 90% quit at stage 2. Every successful trader climbs the same ladder. The stages are as predictable as human development. You can't skip them. You can only climb them. Most don't know they exist. Stage 1, lottery. Larry, trading is easy. I made 50% last month. Still drunk on beginner's luck. Thinks they've discovered something everyone else missed. Greed for quick riches. 90% fail here within 6 months. Stage 2, break even. Betty, I just want my money back. Reality is hit. Hard. They've lost money. Seen the dark side. Now desperately trying to recover. Greed for survival. 70% quit here. Stage 3, consistent. Carl, 2% per month. Every month. Boring, but beautiful. The first taste of real trading. Discovered discipline. Found an edge. Greed for consistency. 50% make it past here. Stage 4, longevity. Linda, I don't trade for money anymore. I trade because I can't imagine not trading. Trading becomes meditation. Money is a byproduct. Greed for the process itself. 10% reach here. Stage 5, master. Mike, everything you're chasing is wrong. Chase mastery. Money follows mastery. Complete transformation. Trading is art. Ego dissolved. Only 1% achieve this. Which stage are you in? Be brutally honest. Type 1, 2, 3, 4, or 5. No judgment, just truth. The evolution isn't about time. Lottery Larry could trade for 10 years and never leave stage 1. It's about identity death and rebirth. Each transition requires killing the previous version of yourself. Kill lottery. Larry's need for excitement. Kill break-even Betty's desperation. Kill consistent Carl's attachment to results. Kill longevity Linda's identity as a trader. Become Master Mike's empty vessel. The cruelest part? You can't skip stages. Like trying to run before walking. Each stage teaches required lessons for the next. Paul Tudor Jones describes his evolution. Stage 1, I was gambling. Stage 2, surviving. Stage 3, I found discipline. Stage 4, I found myself. Stage 5, I found that myself was the problem. Most traders think success means moving from stage 1 to stage 5 instantly. That's not evolution. That's fantasy. Real evolution is messier, slower, essential. What if you accepted your current stage? What if instead of pretending to be stage 5, you focused on graduating from where you actually are? The market will exist tomorrow, and the day after, and the decade after. There's no rush except the one in your mind. Evolution takes the time it takes. You've just discovered the 15 neural secrets that explain every loss you've ever taken. From the biological trading clock that shows why your worst trades happen at specific times, to the evolution ladder that maps exactly where you are on your journey. From the dopamine genetics revealing why some traders are wired for success, to the withdrawal psychology that separates video game players from professionals. These aren't just theories. They're neural realities backed by MIT research, Wall Street genetics studies, and the blown accounts of millions who came before you. Here's my challenge. In the comments below, tell me which one insight hit you the hardest. Which mirror moment made you see yourself differently? But more importantly, what are you going to do about it? Because knowing changes nothing. Doing changes everything. Your 3 action steps. First, download the Greed Audit Checklist in the description. 15 questions that reveal exactly where greed is sabotaging your trading. Second, share this video with one trader who needs to hear it. Their account and sanity will thank you. Third, pick one insight from today and implement it tomorrow. Just one. Master it before moving to the next. Remember, greed built every fortune and destroyed every gambler. The only difference was direction. You now know the neuroscience. You understand the patterns. You have the blueprint. The market opens in a few hours. The same market that destroyed the old you is about to meet the neurologically upgraded you. Will you trade differently? Will you finally redirect your greed from outcomes to process? Your evolution starts with the next trade. Welcome to the 1%.